Major indices trading flat with just under an hour to go in today's trading session. And we're pretty much flat for the week with a lot of mixed data, both on the economy and also what we got from corporate America. On the housing front, the latest out of there, existing home sales declined, falling by 2.4% in the month of March. Now, we also got the first full week of earnings revealing a lot about the consumer. Procter & Gamble saying that consumers are being more careful, more cautious with the products that they've purchased. And earlier this week, Cleveland Fed President Loretta Mester telling Yahoo Finance that she believes economic growth is going to continue to slow this year as the central bank attempts to tame inflation. Joining us now, we want to bring in Francis Newton-Stacy, of a capital director there of Optimist Capital. Francis, it's great to see you. So lots of mixed data. I think a lot of it pointing to the fact that the economy is continuing to slow. How is this shaping your expectations here for the markets, at least in the short term?
Well, in the short term, we have the S&P overbought, and if it doesn't hold 4130 on the close, which it's looking like it's going to do that maybe today or maybe not, it's going to probably revert to the mean 39.35 in the short-term mean, which is still the higher low pattern. However, attendant to slowing growth, decelerating inflation is usually a profits recession, and we're seeing some early evidence of that, and some of the beats that we've seen. JP Morgan, for instance, has an idiosyncratic factor to it in that, they gained a lot of deposit base because people were leaving smaller and regional banks for them. But this is what happens. And then the profits recession sort of leads into a credit situation. Now, we did see the SVB issue, and I liken it to kind of plugging holes in boats. But we're likely to see more of that because the tightening that the Fed started in March of 2022 really hasn't fully worked its way into the system as far as rates go. We've already hit that liquidity threshold in the system where they had to already come in with a bailout, which put 63% of what they had already reduced back onto the balance sheet. It took them 9 to 10 months to get almost $500 billion off of the balance sheet, and they put 63% of it back in 2 weeks. So all of these signs, including, real incomes going down, CapEx spending going down, manufacturing going down, all of these are quintessential signs. And then you get to the labor market, and it is the laggiest of the laggers of lagging indicators. And even now we're starting to see the early signs of the labor market rolling over. So all of this bodes for, unfortunately, more trouble ahead.
You mentioned SVB and the impact on rates. Earlier this week, Cleveland Fed President Loretta Mester spoke with Yahoo Finance and had this to say about growth in 23.
Now, even before the stresses in the banking industry in March, banks were already beginning to tighten their credit standards. And that's because interest rates have moved up. But that's the typical way that monetary policy transmits into the broader economy. So the question now going forward is, will stresses in the banking industry, those stresses in March, lead banks to move faster to tighten their credit standards? And if so, credit will become less available. And that has the same kind of impact on the economy as tightening of monetary policy.
It's a lot to put on your plate here, but will this credit squeeze continue? How will we see it play out? And how significant will that essentially equate to a de facto increasing of rates?
Well, interestingly enough, yes, of course, they're going to continue to tighten their lending standards. And when you think about, how does this impact the system? Okay, so you've got a lot of corporate bonds maturing, right? This is just one of the factors. And particularly those profitless companies that had the junk ratings that, initially borrowed at 4.5%, that now they're going to be looking at, rolling over that debt at 8%. Can they even afford to do that? Credit not being available, you're going to see, businesses failing. You're already starting to see an uptick in bankruptcies. And then you go over to the consumer. You've got 60% of America living paycheck to paycheck. They have less than $500 in savings. And their credit card payments are becoming ever more onerous with every rate hike, which I guess are going to see another 25 basis points. And they're putting food and things like that on credit cards, which are still elevated, even though inflation's decelerating, it's still going up. So you have all of these pressures coming to a head at a time when you're reducing liquidity in the system. And historically, if you look at the major bear markets of 2000 to 2002, and you look at the '08 global financial crisis, what happened? You had leverage in the system, way too much leverage in the system. You had bubbles, you raised rates, you burst the bubbles. Okay, now we have more leverage than ever before in the system, attendant to inflation, those things together, and we've raised rates at a record pace and tightened at a record pace. So the mechanics in the system haven't changed. I'm not saying that this is going to happen tomorrow. In addition to that, you have the debt ceiling conversation. So which one of these shoes drops first and which one drops when, I don't know. But all of that bodes for the fact that this is really a bear market rally akin to 2001. And basically, the credit conditions are going to determine more weakness in the equity markets going forward.
Francis, you mentioned the fact that you're seeing a tighter labor market here. Torsten Slok of Apollo, he was out with an interesting note this morning, and one of the graphs that he had pulled up is the fact that fewer companies this earnings season so far, we're only about a week and a half in, but fewer companies are mentioning labor shortages. How tight is the labor market? And do you think it's more of a result of the fact that some of these workers are leaving the workforce, or actually some of these people, I guess, we're seeing a little bit more displacement than maybe what we initially thought we were going to see?
Well, what was happening initially is people were being laid off, for instance, from tech, and then they were just running around and finding a new job. And so now you're seeing the uptick in jobless claims, and it's actually up 44% off of the low for continuing claims. You know, you're seeing this happen because that's not happening, because what they're having to deal with is they're having to deal with margin pressures to try and keep, the earnings situation higher. And the costs have remained, inflation's been sticky, costs have been high, so they're lowering costs. But what they're really probably not prepared for is the demand coming off of the top line at the rate that it probably will, should we have more credit problems. And, that 60% of America that's living paycheck to paycheck, that's the majority of people. So while the 40%, which are sort of defined by having assets and savings, are still spending, also things that were kind of keeping the bubble inflated, if you will, was, consumer spending and retail and savings and all of these things that, came out of the pandemic. All of those things have rolled over simultaneously. So it's just looking pretty dire. I don't like to be overly negative. It's just, we have to look at the data. We have to be responsible. The risk is rising in the system for a credit event every single day because the tightening hasn't worked its way through the system. We're continuing to tighten. Now lending conditions are following those interest rate hikes, as she pointed out, as is always the case. C&I lending is going down, and that's all liquidity falling out of the system when those loans are coming out.
A healthy dose of skepticism about the markets indeed and the macro. Francis Newton, Stacy, thanks for joining us. Appreciate that.